The best forex trading software relies on price action. Indicators are probably the most overused tool beginning traders rely upon in any market. Whether or not you can make money with them or not has probably been the most discussed topic in forex overall. What does an indicator tell you? Technical indicators are merely graphical aids which are generated through simple or sometimes complicated arithmetic operations based on data that you already have access to. That is simply the information that is already there in front of you in every candlestick. There are many different indicators for you to choose from, but how do you know which one to rely on? What I'm here to tell you is that there's only one thing that matters inside of a chart, and that is the price. Nothing else and nothing more. The way it moves, the way it reaches the highs and it reaches the lows. That's all there is to know about the market. Indicators obviously lag because price cannot predict itself. That makes sense, right? The truth is there are only two indicators you'll ever need to trade with. They are the quarters theory indicator and the trader's dynamic indicator. Put them both together and you have the Rock Manager Forex trading software. It is unlike anything you have ever seen. This chart example, you can see the pound yen from the middle of September on a daily chart. It cycled up exactly to 180.75, which happens to be a hesitation zone in our software. And then it cycled down 1,250 pips to the 168.25 hesitation zone. The trade trigger on this would have been the green RSI line out of the blue band on the trader's dynamic index signaled a potential reversal. The number signaled where the reversal may occur. As you can see, this pair traded down 1,250 pips and it bounced at 168.25, and it has since risen roughly 500 pips. The quarters theory indicator, it levels the playing field to your advantage. It uses a well-defined mathematical formula that all retail indicators use to create their signals. What is the quarters theory indicator and how does it work? The quarters theory is a revolutionary new foreign currencies trading method that is based on price action and was created by Ilyan Yotov. His book is available on Amazon, The Quarters Theory. Ilyan Yotov is familiar to many traders as the creator of the quarters theory method and is one of the FX market's top strategists on Traders Television Network. Ilyan is founder of forex.com and Trader Tape. The quarters theory is based on the premise that the daily fluctuations of currency exchange rates are not random, and that currency exchange rates fluctuate in an orderly manner between large quarter points within each 1,000 pip range, defined by two major whole numbers, or major large quarter points. The quarters theory proposes that every significant price move in currency exchange rates takes place from one large quarter point to another in gradual increments of 250 pips, the range between two large quarter points. The quarters theory challenges that the forex moves are random. Within its clearly defined, consistent price ranges of 250 pips and orderly price moves from one quarter point to the next, the quarters theory organizes the daily fluctuations of currency exchange rates in a systematic arrangement. The quarters theory provides the roadmap. The 1,000 pip ranges divided into 4 equal parts, or 4 large quarters of 250 pips each. and establishes the route with a distinct starting point and a clear destination. Every significant price move begins at a large quarter point and ends at a large quarter point. The quarters theory takes a 1,000 pip range and it breaks it down into 4 quarters of 250 pips each. The major round number, also known as major large quarter points, are drawn in red. The major round numbers that are drawn in red are also known as major quarter points. They are 1,000 pips apart. They are divided into 4 quarters of 250 pips each. This round number is 270.00. This large quarter point is 260.00. The first quarter point is 267.50. The second one is 265.00. And the last one is 262.50. So each one of these quarter points is 250 pips each, which breaks down 4 quarters out of a 1,000 pip channel. The large quarter points are drawn in black, and the major round numbers or large quarter points are drawn in red. Within each quarter point of 250 pips, there are important price zones. They are identified as the half point and the hesitation zone. Here's the half point in a black dotted line, and here is a hesitation zone in a blue dotted line. The half point of a large quarter is the exact middle price point of each large quarter. The half point is positioned exactly 125 pips from each one of the large quarter points that define a large quarter. The hesitation zone is the range of 75 pips above or below a large quarter point. The hesitation zone is formed by the first 3 small quarters of 25 pips of each large quarter. The positioning of the hesitation zone depends on the direction of the price move. If prices move above a large quarter point, the hesitation zone will be 75 pips or 3 small quarters above a large quarter point. If prices move below a large quarter point, the hesitation zone will be 75 pips or 3 small quarters below a large quarter point. The hesitation zone is a range of 75 pips above or below a large quarter point. Here is a large quarter point, 172.50. The hesitation zone is 75 pips above a large quarter point and below a large quarter point. In this example, the hesitation zone is 173.25 above a large quarter point of 172.50 and 171.75, which is 75 pips below a large quarter point of 172.50. The numbers don't lie, and when you utilize these numbers in your trading, along with our second trigger, the trader's dynamic indicator, together they provide you with excellent areas to hide your stop loss behind. They act as invisible force fields that contain price action. As you can see in the following chart examples, use a Rock Manager Forex software with the trader's theory indicator and the trader's dynamic index, and you will truly learn how to trade price action based on the hidden numbers that control the Forex. As you can see, in the hesitation zones contained price action on to the pip on the pound yen on a 4-hour chart. The high on September 18th, 2014 was 180.75, and the low on the 8th of September was the hesitation zone number 169.25. How do we trade with the Rock Manager Forex software? We find a 1-hour chart where the Trader Dynamic Index paints an overextended signal, and we find the nearest number to focus your entry on. And then we drop down to a 15-minute chart to plan your entry. As you can see, the green RSI line is above the blue tracer or volatility band, and so we drop down to the 15-minute time frame to plan our entry. Step 1. Find an overextended Trader's Dynamic Index on a daily or 4-hour chart, and we locate the next number in the sequence. In this example, we have the large quarter point of 1.500 on the pound Swissy daily chart, and we have an overextended TDI. Here's the 4-hour chart, and again it shows the 1.500 number, and it's already bounced. So we drop down to the 1 hour and the 15-minute to find an entry. You set an alarm just before those numbers, and you wait for the alarm to call off, and then you buy with a very tight stop loss on the 15-minute time frame. And then lights out, baby. This pip ran last week for over 200 pips with a goal of 250 pips with a 25 pip stop. That's a 10-to-1 risk reward ratio. Other examples on a 15-minute chart, we had an Asian accumulation session. The pair cycled out of the box. It cycled up to the small quarter point at 171.00. It bounced. It cycled down to the small quarter point of 171.00 and bounced and made a perfect W. Bounced again and cycled back up. This trade, you would have had 100 pips to the downside. You got out. You would buy at the low of the day, cycled up for 100 or for another 50 pips. So you could have had 150 pips on this trade using the Rock Manager Forex software with the quarters theory indicator. Here's an example of the Euro Aussie on 9/8. Pair cycled down, it bounced 135.00, small quarter, it bounced, and it cycled up roughly 125 pips, and it bounced exactly at the hesitation zone at 139.25. As you can see, all price action patterns originate at specific predefined numbers that are hidden on your charts in plain sight until now with the quarters theory indicator. Get the edge you have been searching for in your trading. The truth is that the movement in the forex is not random. These special numbers contain price action on a daily, weekly, or a monthly basis. As you can see, the forex market moves in a well-defined mathematical formula. The market makers use these secret numbers to reverse price action when you least expect it. Use the Rock Manager Forex software powered by the quarters theory indicator in your trading. Start placing your trades with more confidence and precision. Take your money back from the market makers and then beat them at their own game. Get the Rock Manager Forex software. Trade like a market maker or don't trade at all. And I want to thank you for watching this video.